there's such a range. I know I was just looking at this earlier. Goldman Sachs says 50. UBS say there's going to be 275 basis points.
Cuts.
Yeah, 11 times 25 basis points because there's going to be a recession. And then FedWatch are pinning it around 125. So that's what like the layman thinks.
But there's others who are saying zero, right? And,
yeah, it's just unbelievable. I don't know how anyone's going to supply and demand this.
Hi, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, Chief Executive on Its Capital Group, joined today with Martha and Vincent from Research. Please remember to like and share and subscribe to us, hopefully on YouTube, where we go through, bits and pieces, graphs and all that. Right, cool. So diving straight into it, start with you, Vincent. Outright prices.
Yes, outright prices, as you see on the screen here, around Brent futures, February 2024, around $76. There's been a small rebound higher over the last few days. Last week, prices in WTI did fall below 70 at one point, just outlining how bearish the sentiment is in crude, as the market is unconvinced from the latest round of OPEC cuts. However, it does seem like shorts are happy to take profit at these levels. The market is very much macro driven in a wait and see mode. Last week, the sell-off was also attributed to heightened recessionary fears in the macro scene. This week, we're waiting for the CPI data at the time of recording, as well as the outcome of the Fed's Federal Reserve meeting tomorrow, which will perhaps better inform traders on how interest rates moves will go in the coming year ahead. So very much in a wait and see mode, consolidation in the 70s range. Still very bearish narrative. However, it is worth mentioning that money managers are going very short in WTI futures, and market positioning is very much saturated towards the short side. So the market at these levels is vulnerable to short cover flows.
Yeah, I think we've kind of said that kind of wait and see during OPEC, and I know what you mean, but I think that there has been a pretty decent shift to stronger conviction, right? As you say, the money managers at the very least are getting very short. I would say the evidence looks like more majors, trade houses are kind of still staying out of it, not yet quite convinced. But the talk generally in the market in North Sea and generally the physical right now is looking pretty horrible on the crude side. A lot of oversupply, a lot of crude pointing into Europe again from Gulf Coast. So I think we've actually moved away from a wait and see into like a kind of, it's a bearish market. But then ironically, when you get a bearish market and people kind of agree on it, you tend to get a slight reversal as, dead cat bounces and things like that, people taking profit. So that looks like what's going on. What's the attention turn to now? I mean, I still feel it's whether or not, trade houses and majors put on their positions for next year. Their positions are like oil tankers, right? They're big and slow to move, and I think once they come in, it will be quite. It will trigger the first momentum in the early year next year. So I think it looks like this should be on the downside, but we could get a surprise. As you say, the market's probably vulnerable to a short covering right now. So yeah, anything you want to add to that, Martha?
Yeah, moving away from financials into more kind of fundamental news that we've had over the week. We've had Dangote Refinery in Nigeria. We've heard it be delayed a few times over the past year, and then we got announced that it was going to be starting at the end of this year, and it's finally received its first shipment cargo from Shell from Nigeria. So that's a big step forward for them, and it'll be interesting to see if they can continue on their path of opening up how they're going to. I think it's going to be focused in middle distillates, diesel, a bit of gasoline, some NGLs, so we'll see. Yeah.
Just a bit of gasoline.
Just a bit, yeah.
I think it's quite a crucial one because West Africa is an outlet for the European gasoline. So the traders are reliant in Europe on taking kind of EBOB spec and making the changes to send into the US, but also West Africa. So a reduction of an outlet, in other words, the more that West Africa can take care of their own supply of gasoline. In a way, it's kind of bearish because bearish the EBOB contract because there's less of that less outlet to go. So more of it will have to point to the US. So it's going to be an interesting one. I think a long time ago, a trader even said this is the end of the European market. I think that's a bit of an exaggeration, but I get the point. There's going to be some restructuring. I also think it's worth noting that if it does run light sweet, that's got to be one of the first refiners that's can absorb the incremental increase in light sweet supply we've had from the US and even WAF itself, West Africa itself. So I think that's kind of good news for traders and crude rather than gasoline, because they can have one more outlet to place there. So yeah, it's not really going to have much of a global impact, but actually quite a big impact potentially on the structuring of the underlying market, as in our niche market. So that's quite interesting.
The rhetoric now is definitely that they're focusing on getting self-sufficient in Nigeria, and they're going to keep it all very local, but it'll be interesting to see whether they fulfill that.
But every time they do that, it means oil traders around the world doing it less. I mean, the amount of trade houses that set up to do these kind of niche deliveries, it's potentially them out of business. Cool. So why don't we move to refinery margins, Martha?
Yes, of course. We've seen a week-on-week decrease for the first time in a long time. Only a few cent. What is it? 25 cent. So we've got it up on the screen here. And so Monday to Monday, this is a 25 cent decrease, and this is in comparison to the weeks previously, which has been led by the week dated. This has been led by the weaker products, which is pretty significant. And in comparison to how we've seen before, which is gas oil leading the weakness of the products, this is now EBOB leading the weakness in the products, which I'll get onto more in a second. Of course, gas oil is still really weak. We're looking at 5-year lows in the gas oil stocks in the US and in Europe, and just, it's not really seeing any reaction. Looking at the CFTC report, we're continuing to see longs reducing their week-on-week positioning and shorts increasing theirs. We're now looking at managed by money positions being in the 15th percentile for all weeks to 2013. It's a really bearish market, and it's just decreasing week on week. There's no strength here in the refinery margins. And then EBOB, there's a bit to say about EBOB, to be fair. Rubber hasn't been particularly strong. Data revealed yesterday shows that the stocks in the US and Europe, the US was shown last week, but the European stocks in November are up 1 million barrels, and US have seen 3 weeks of increasing builds, shown in the graph here, up every week, which is pretty damning. And just looking at the financial flows into EBOB, we've seen trade houses, refiners and funds sell side of both the prompt and the Q1 EBOB crack. This is the Q1 being shown here. But on the other hand, we've seen some good back-end buying from the trade houses, which I think Vincent will speak more about later. But the open interest in the prompt contract is sky high, and it'll be really interesting to see where the market goes from here. The US stockpiles for gasoline are within the 5-year average, and looking at the option skew, we can see that the week-on-week changes has left the put options with a lot lower volatility skew than they have been in the previous weeks. So the market is looking less like it's waiting for more bearish price action. It's not looking to be protected against that. So we may see a leveling out here. I mean, rubber's been not super crashing in the past few days, but we may see a leveling out. We may see players more willing to put a bit of risk on in the bullish side. So
I think just to hold ourselves to account as well, we've been tracking gasoline quite a lot in the last couple of months. So we were definitely bullish kind of across the board, really. And then kind of weakening gasoline east-west as the quotas came out from China, I think, was the main kind of justification there. And those positions that we were bullish on Q1 EBOB crack, and we keep saying EBOB, I think someone in the comments what is EBOB? European gasoline contract. So that performed and everything, kind of bounced back from lows and whatever else. But now it kind of looks like if you haven't taken profit, it is a good time to take profit. It's looking bearish. It looks like the narrative is bearish. It looks like the fundamentals are bearish. And as you say, the options skew is great added information there. So yeah, that's quite a big deal. And I think let's not forget that, we say that the US managed by money traders, the retail traders, investors, they rely a lot on macro information for their trading. They also rely a lot on RBOB, right? The gasoline is a big part of the US economy. And when they're trading oil, they absolutely consider RBOB. So a weakness in RBOB is probably correlated with a weak sentiment in crude in general. So I think it looks like from the US perspective, investors and financial market players there, they are certainly very bearish across the board. So again, with their momentum, that could be an interesting one. Anything to add, Vincent?
Yeah, so for all the talk about how bearish the sentiment in gasoline is, my trade idea, which I'll talk about later, was actually going to be a contrarian one, going long in the Jan-Feb EBOB spreads for reasons I will be outlining, because for all of the fundamental reasons, because of the technical analysis or the financial flows that have been analysed, there could also be a bullish case as in a temporary rebound in particular, because once you see the spread being oversold, maybe it's time for players to take profit, or it's testing previous support levels. So
I think this is key, because it doesn't matter if you're bullish or bearish, the underlying. It's about trading. Trading's trading. So yeah, this could be an interesting one to go through, because it's a good way to demonstrate, you can still buy when things are bearish. It's just very risky, and you need to have good risk management protocols, good trade structuring. So no, I think that's very interesting. Anything else? We've got the regrade being strong.
Yeah, the regrade has been particularly strong. So it's looking at the January contract. It's actually been trading on the positive levels, which is actually quite a rare occurrence.
Regrade being the Sinkero, which is basically the Asian jet benchmark versus the Asian diesel. So it's a differential. So what we've seen it negative for a while, you're saying, and it's gone positive for the first time in a while. So that kind of indicates basically more profit margin for refiners to make jet over gasol, or diesel. That's the relevance of it.
Yeah, that's a little indicator. So it's a signal for refiners that it's more profitable to produce jet fuel over gasol or over diesel. So in this sense, it is a rare occurrence, showing strength in Asia jets, with fundamentals quite strong. Perhaps a heating demand in Northeast Asia, as well as buying coming in from Australia. But at the same time, there had been a lot of short covering flows as well, which triggered the rally upwards. Because even like a few weeks ago, some buying flows have been observed in December regrades, even at 50 cents, 60 cents, 80 cent levels, which is generally quite unprecedented. So, in this market, so there's a tendency, we want to always find a reason to explain something, why prices are going so high, but sometimes the strength does defy expectations. But ultimately, it does provide a sell side signal for traders to show that it is more profitable to produce jet fuel, and therefore by producing more of that, there'll be more sell side hedging flows coming in, and eventually the regrade, the Kero versus gasol, must correct downwards, which we're actually seeing some pressure at the highs recently. So this
from
is
these hedges, sell side hedges.
It sounds like it, but
so it's refiners then, essentially.
Refiners. So it will be an interesting one to watch, to see if in the front month, which is January right now, to see how long these positive levels can be held. And it can go two ways. Either one, we see a regime shift, so we will see the regrade trading above zero for a long time in the coming months ahead, or it will quickly correct down below $0. So the market is really in a phase of price discovery right now, so really is a one to watch.
Yeah, no, super interesting. And when you say the expectations, defying expectations, is because we have a fundamentally weak signals coming out, or?
Not necessarily, and it's more in the sense that the value is so notionally high that the market, at least for analysts, there's a bit of confusion about how the market will go, how the regrade's performing. Like, does it make sense for prices to be this high notionally, similar to how we saw in the gasoline and diesel cracks last year as well? Yeah,
it makes sense. I guess on that point, it's more about the jet fuel users. The interesting thing about kerosene, so it's a jet benchmark, but it's also a kerosene benchmark. And Q4 historically, it's seasonally a bit more bullish because of the heating demand, cooking demand, things like that out in Asia. So it's interesting. The only other thing is looking at naphtha as well, because when jet gets strong enough above gas oil, it's encouraging general blending, right? So there's no clear cut on the barrel for gasoline or jet. It's, if you see these, it's a big naphtha cut, right? And then you just blend around it. And so I think the blending into jet can be possible when jet gets expensive enough, and naphtha is strengthening quite a bit, so maybe not, but it would be slightly supportive for naphtha, you could argue as well, the knock-on effects. But anyway, it's just generally an interesting contract. Okay, cool. So one to watch.
Yeah, again, US CPI and interest rates coming out in the coming 2 days. A lot of macro discussion these days about talks about whether recession will happen in 2024. Perhaps some more expectations of a hard landing rather than a soft landing. So it is a bit of an irony here in the sense that interest rate cuts can be seen as bullish for oil prices because it will trigger more demand, more consumption, but it could also be a bearish signal as well because the central bank has to cut rates in the first place because they're anticipating a recession, so
stimulate again, yeah.
As to stimulate again. So it's very circular here. It can be. There's no one single way to interpret this.
Yeah. Well, the bond market has been pricing in multiple cuts. As you say, we're only really discussing the narratives here, and I think that's important. Leads to positioning, the knock-on effects in bond markets into oil markets, commodity markets. You know, it was quite bullish, the fact that people were saying, actually, look, we're getting a soft landing here. And the supply and demand models, those fantastic forecasting tools that are so effective, they are being, what I'm hearing from the industry is that part of that modeling is based on a soft landing. So like anything, if that doesn't happen, that completely destroys your demand forecast and destroys the demand that you were kind of expecting, and it just throws everything into kilter. So it is strange, but also very interesting. And I think it's a very valid one to watch for oil traders because it's just all of a sudden changed to bearish again in terms of the macro sentiment. We had, I know people are saying we've had, bearish economic data out of China. We've had this and that, but actually a couple months ago, it turned to soft landing. Oh, this is kind of bullish again. And now suddenly it's flipped back. You got Goldman Sachs, as you put here, projecting 2 Fed rate cuts. But the Fed's saying, no, we're not. And you got other people saying it's going to be very high for very long. It's all a bit of a shit show.
There's such a range. I know,
right.
I was just looking at this earlier. Goldman Sachs says 50. UBS say there's going to be 275 basis points.
Cuts.
Yeah, 11 times 25 basis points because there's going to be a recession. And then Fed Watch are pinning it around 125. So that's what the layman thinks, or the trader thinks.
Yeah, but there's others who are saying 0, right? And
yeah, it's just unbelievable. I don't know how anyone's going to supply and demand this.
Yeah. So I think, how often does this happen, right? A lot of people are expecting a recession in 2023. It was, even 2022, but especially 2023. And that was meant to be a leading kind of narrative for 2023. And I think a lot of people traded off the back of that, but it didn't happen. And then when you think it is going to happen, as in you are going to get a soft landing, it doesn't happen. And that actually kind of makes sense in a weird way. Because if you are trading the forward curve and the result of the forward curve creates a recession, you see what I mean? Like everyone anticipates there to be a recession. People got their act they got themselves in order, right? And if you're preparing for it, you're getting into cash, you're de-risking portfolios, and there wasn't this big crash. I think people were quite on top of it. Now maybe people are getting a bit lax again. Inflation coming down, government's getting a bit more bullish, good economic data coming out of Europe at least, and the US or UK, I was saying. But either way, because there's no strong narrative and because people aren't worried about it, it's almost like they should be worried about it. So if maybe there was just a delay in this thinking that actually it wasn't 2023, it's going to be 2024. It's all over the place, but it's yet another thing that it doesn't look like there's going to be some surprise bullish market. But again, it's up for discussion. I mean, everyone out there is as good and as in a position to call this as we are, as anyone is. So I really kind of think you're absolutely right there. How when we say one to watch in a scenario like this, like what can you actually do? You're just going to read headlines, and in a market like this, people are going watch it, but people are going to be like swayed by anyone with conviction. This is the tricky thing about markets like this. Someone comes out and puts a really strong statement out, and people follow them because that's kind of in human nature. They want these leaders, so it's kind of rife for someone to come out and say, right, the biggest crash ever since which we kind of had in 2022, and it didn't happen. So We've had a lot of bear mongering for a while in macro. It hasn't happened. Is there going to be someone else? They need to have a new convincing story. It's a bit like OPEC, right? They come out and say, oh, everyone's going to be out shitting, or we're going to do this, we're going to do this. Like, if you say it 1,000 times, the 1,001th time isn't going to work, right? And I think that's kind of maybe the case here. But I don't know. It's not like I'm concluding anything. But I guess we just got to keep looking at headlines, looking how people are discussing, look at the data, and kind of weigh up and just try and look for evidence and positioning. And when there is a high conviction market, which you'd expect kind of after Christmas and as we get into the new year, that's when that kind of momentum signals will probably be there to kind of take a view. And well, actually, yeah, we've also got one to watch. Martha, you want to talk about the shale oil stuff?
Yeah, so this week we've seen Occidental Petroleum agreeing a $12 billion US deal to acquire Crown Rock, which absolutely, really boosts their position in the shale sector. Another one. Yeah, another one, last one, 2019, I believe. So it cements Oxy's position as the second largest player in the Permian, and that this should mean once they're producing about 1 million barrels per day, but in August, they're going to be the 6th producer in the lower 48 US states of 1 million barrels of oil equivalent per day. Like, these are huge companies. And we've got a graph here shared by Reuters from Rystad that shows the new mega majors production compared to each other. So they're the ones in bold. We've seen the two others this year that kind of coined the term mega major, the Exxon and Pioneer merger, or acquisition, I'm not sure. And then Chevron and Hess as well. And I was saying earlier another one, because in 2019 we saw Oxy acquire Anadarko Petroleum, which is outbidding Chevron, another kind of bidding war. And by 2022 they were the second largest producer in the Permian because of this. And so they're just carrying on and acquiring. And yeah, it's been a huge year for M&As.
A huge year for confidence in shale.
Yeah. I mean, compared to last year we saw hydrocarbon M&As in the US fall by 35%. And about 80% of these deals were LNG based. And I mean, there's been a few big ones this year, but not in this scale. And the average size of the deals fell by 33% last year. So, I mean, it's been a real trend reversal.
Yeah, I mean, the only thing I can add really on the derivative side is whilst Exxon, Chevron, obviously they do trade, but they are so big, they kind of pick and choose. I think Occidental have had an increasing derivative presence in the last few years, especially as they became so big in the US ARB, crude ARB. So, more of that, more oil to move, could be more derivative hedging off the back of it. Whereas I think Exxon, Chevron, like a bit more reluctant to hedge those kind of things. So maybe not anything huge, but just something to keep an eye on. But also a lot of competition, right? So as we head lower in prices, the margins are going to get tighter, and especially because they look like they're not looking to hedge the outright price. A lot of these major companies, they're going to be fighting for these lower margins, and trading is going to become a significant part of their strategy, or at least needs to be. So yeah, if anything, you can see the trading volumes going up quite a bit as we move south. All right, so Vincent, to your contrarian trade idea.
Yes, so my contrarian trade idea is looking at going long the Jan-Feb EBOB spread. Previously, as you guys mentioned, yes, the fundamentals are looking extremely weak for gasoline, and with Dangote Refinery coming out, EBOB is, they say EBOB is dead, like how the famous philosopher Nietzsche says God is dead, and when Dangote Refinery opens, EBOB is dead. But maybe not quite.
Stretch.
Not yet, as I would argue here. Currently, it's fair value is around minus $4 per ton in January, February. It's looking like it will be testing previous.
These are very low levels. So I see your point. We've gone back to like historical lows. We're actually building storage now. Would be indicated by the contango. So yeah, storage buying could come in. When you're in contango, there's kind of support levels that can come in off the back of hedging flow quite aggressively actually, and it gives traders optionality. Buy, and then if there's no demand, store, as long as you've locked in the contango spread. So yeah, there could be it's actually quite quite interesting, just purely from a technical level, you saying, but actually there are fundamentals behind this as well. Sorry to cut you off, but that is quite interesting.
No, for sure. Contango storage plays, this gives traders, physical traders, a bit of optionality and potentially a good level for speculative length to enter as well. Looking at the dashboard, looking at market trading split, past 7 days there's been more buy side flow in Jan and February, as well as looking at the Jan-Feb spread as well. The market seems to be getting longer. There seems to be buy side interest as well. Looking at technical indicators, it is clear that RSI is in oversold territory, so it may be plausible to say that the spread is overextended on.
This is a really inventive trade. This is really, really interesting. So just to summarize that, we've been a bit of a free for all, but we've hit historical lows. We've got a kind of technical support level. The RSI indicator, which not a lot of people look at yet for these niche futures, but you're looking at it and saying, the maths is showing that the RSI is oversold. You've also got a justification for people to come in and buy on the back of hedging. And as you say, trader optionality, that's a really good point as well. Then you're compounding that with traders actually recently buying back gas naps from being short.
Yes.
Did you say that? That's in the notes.
Well, it wasn't mentioned, but that's in the notes.
That's in the notes. And then in the positioning, people are generally buying gasoline.
Generally buying gasoline and gas naps as well, but that's more short covering. Short covering.
But either way, I mean, from a technical, it's a really nice spot. The tricky part is going to be structuring the trade when everyone's in this kind of bearish mode. So are you trying to catch like a reversal and then people are just not expecting it? And so what's great about those trades is if it does happen and people can't make sense of it, it's much more likely they will stop out. Because like you were saying before, defying expectations. So what do you do when you don't understand what's going on? You just want to get out. So if that's what's happening and people haven't put these things together, it's a great trade to, what everyone, a bit like the recession argument. No one's expecting this. So you buy it and then catch everyone unawares. Is that what you're looking for? Or is this a short-term thing, or what would you say? We
are looking for a short-term thing, not to catch other people unaware, but we do see a potential rebound in the short term at these levels.
Okay.
So if it fails to test and break the support level, and go down further, then we could see a rebound back up to around -2 or -1.5 per metric ton.
So there's a couple ways to trade that. So you're saying purely technical, you can put in entry level, but there's also, if you're trading OTC, right, which I guess some people aren't, they're trading through market makers or direct, whatever. But the point is that if you can know what the flow is going on, subscribe to Onyx, research.
Yeah.
Once you see contango hedging, that'll be a great indicator, just a first sign of it. And because you have all the other things laid up, that could be your signal for entry as well as the technical. But yeah.
Looking for that, and to add to that, we would like to set a very tight stop loss initially, perhaps around -4.5, just because if it doesn't go the way we want, if it breaks the support level, then there will be further downside. We think more longs will be stopping out, so we want to set a tight stop loss first to kind of...
Are there many longs in the spread, do you think?
Sorry?
Are there many longs in the spread?
We have been seeing a lot of buy side flow recently.
Yeah.
There has been longs. However, from a technical perspective, like if the prices keep on going, if prices keep going down, then that disproves our hypothesis. So we want to exit as soon as possible. But if it goes up, then
okay. So what about taking profit? Because you've just said it's short term, only a few weeks away from January pricing. So you have to be a bit careful about if it is short term. Like, what are you expecting on the upside?
Short term upside back, expecting a mean reversion back to -2 to -$1.50 per metric ton levels, as we see in the chart here.
Okay.
And this did actually happen a couple of weeks ago. So in this trade, we see that a similar event might happen before. History might repeat itself.
Yeah, I mean, again, there's causation there, right? So that could be evidence that is a good level for people to lock in contango. So yes, you expect that to happen again. Okay. Nice one. So trying to take profit around there. Is there any evidence that that's a good level if you buy low enough, you buy where it is now, that taking that into pricing versus the physical premiums could offer a good risk reward? Or
this one I haven't
really considered. Okay,
no.
No worries. Okay, to our poll part of the podcast then. Our latest poll was, when do you expect OPEC to fully unwind their cuts? This was a really interesting one for me, because there's a lot of talk about, quotas and what level they cut from and this and that. But going from the base case of the original, like, let's say, maybe not the pricing war peak, but certainly, let's say the pre-COVID levels, how do we get back to that? And most people think that will never happen, which is pretty interesting, actually. And I concur, because there is just too much oil in the world, essentially, and it's growing non-OPEC. I mean, we've talked this to death, but I think that's interesting that a lot of other people are saying it as well. But then some people think, well, it's kind of mixed. DEC 24, June 25, 25, 26. But really, most people think never. Anything to add to that, you guys? What did you vote?
I've no comments.
Right to privacy, right? You're right.
Not my place to say, but I would say
it's a vote on a poll.
Yes. I don't want to be leading leading anyone here. Wouldn't be surprised to see any of these. All of these responses are quite plausible. Never, because people will be seeing that OPEC is stuck between a rock and a hard place with a dilemma with respect to the market share. They've been cutting non-OPEC producers, US shale, saying thank you very much, taking advantage of these. So it really depends on how fast global oil demand can recover over the next year or so, how that affects people's supply and demand balances. That's are
you running to be an MP in New Zealand?
How did you know?
Such a political answer. Go on, Martha. What did you vote?
I would have voted never. I think there's the video. Have you seen of the Crown Prince of Saudi Arabia and Vladimir Putin, and they're like really throwing out, and everyone.
That was a while ago, no? Or?
It was this week.
Oh, okay. Because they've done that before.
Yeah.
Okay.
And everyone, as soon as something like that happens, everyone on Twitter is a body language expert. And they're saying, oh, it's gonna, this is gonna mean this, or there's gonna be another price war. It's gonna, they're gonna cut until oil's 100 again. But I think that it would be wise. Well, I would say never.
Interesting. Yeah. Okay. Well, a lot of information packed into that episode. Thanks everyone for listening. Again, please comment and give us your feedback, what you'd like to hear, what we can discuss, and all that. So tune in for next week, and that will be our last podcast, I believe, for the year. And it's been a really interesting year, really great year, and we'll talk more about that maybe next week. But ahead of that, just a quick thank you for those listeners who have come to our audience. And speak to you next week. Thank you.
Thank you.